Hey, it's Greg Rand, and this is a portfolio review of Cleveland, Ohio, 12930. Asking price 1.5 million and change, 24 occupied single family rentals. This is going to be a fun one because I'm going to use the occasion to show you a couple of the features that we have on the portfolio visualizer to help illustrate the opportunity and test a couple of assumptions. So here's how we go about trying to tell the story of a portfolio. It's a combination of the numbers and the market fundamentals. So here you have an asking price of $1.5 million. This is our yield calculator, and it assumes no mortgage balance. The monthly rent of $20,000 has a vacancy assumption of 5% of turnover. That gives us a gross yield of 15.8, which is awesome. Nationwide, that's among the highest that we see out there. There are reasons for that. We'll get into them. Taxes are actual. Management costs are an 8% management fee and a 10% maintenance reserve, getting us to a total expense load of 37.19, which is pretty responsible and reasonable. But I actually am going to increase it just because I want to even have this thing be a little bit more conservative. Let me keep going. Let me say I'm going to do $32,000 in maintenance. All right, good. So that puts me at a 40% expense load, which is an institutional level expense load, which means everything is accounted for. No place to hide. Net yield of 9.48, among the best in the entire country, so that's pretty awesome. But the rate of return is only 9.88. And what you need to know about the rate of return is that we just do a very simple combination of the net yield plus the average appreciation rate for this portfolio over the last 20 years. All right, I'm going to scroll all the way down here to show you that chart because it's a really interesting thing to try to project what might happen with price appreciation, or at least account for a responsible appreciation or lack thereof on a portfolio so that you can see the full picture, because it isn't just yield you're going to get from this, it's also appreciation. And if you use some leverage on it, you're going to get an even higher rate of return. And we always go to this chart so I can point out to you that the blue line is the US, and you try to see if you can establish a trend line during calm seas. Okay, you see the boom and you see the correction. And what I always do is I've been served very well by this analysis. Take a long-term view, establish a trend line, split if there's a peak and a trough, and then carry it forward. And that's where the market kind of wants to be, which is why I project that the United States overall is going to keep appreciating. All the market fundamentals support that theory, but this chart does as well. Okay, but different story in Cuyahoga County. This county appreciated a dismal 0.4% a year on average for the last 20 years. National average is 3.44. State average of Ohio was 1.42, and this is below. So this county right here shows a very, very slight appreciation during the calm times, not much of a real estate boom, a pretty nasty real estate correction that, as you can see, had very little to do with the real estate boom. It had to do with the erosion of the manufacturing industry that had been going on in that part of Ohio for a very long time. But here's the thing I want to point out. If you do research and if you pay attention to what's happening in Cleveland, what you know is that the job situation is improving. It's not happening overnight, but you've got an influx of manufacturing into the formerly strong manufacturing bases across the Midwest. And one of the things that I found fascinating about Cleveland when I spoke to people from the market who really knew it is that the erosion of the manufacturing base in Cleveland was, in Detroit they make cars, in Cleveland they made parts, okay? So call it door handles, all right? They don't make the cars. It's very hard to repurpose a factory that was built for making cars into making something else. Not so hard to repurpose a factory that makes door handles into making something else, like, for example, medical instruments. And the medical manufacturing industry came in to a lot of those factories, were able to get in there for a song, repurpose a lot of the manufacturing workforce, and a lot of what eroded, not all of it, but a substantial enough amount of what eroded in Cleveland came back, at least partially. But Cleveland was also converted from a manufacturing economy to a service economy. So what you're beginning to see is appreciation based upon the overall lift of the economy right now. But look at this 3-year period is the steepest increase in value that we've seen since the very, very peak of their version of the housing boom, okay? And what I believe is happening here is that if you look at this line and you again carry the trend line forward before the volatility, you carry it forward, it would bring you all the way out here. I'm not saying that's where we're going to end up, But I am saying that this lift right here is real. I think it's going to continue. And over time, you'll look at this line and you'll see that this little juke right here was something that corrected itself. And I think we're going to see a better appreciation rate. So what does that mean? And let's scroll back to the top in the calculator. We have visualization tools here for you to be able to project the cash flow increases based upon the increase in your rent that you assume and the increase in your expenses that you assume. You also get a chance to see the increase in investor equity. And as you can see, it's very modest because this is assuming the appreciation rate of 0.4% annually will continue. But I'm going to test something here. If I go back down again to this chart, I see the state of Ohio, which has also suffered some erosion of manufacturing jobs, has also rebounded, is looking at a 1.42% annual appreciation, again, compared to a 3.4. So less than half the national average. But for me, a kind of a reasonable assumption to say, if I think this is going to improve, if this is a 3-year trend that I think is going to continue, what number can I plug into the projections to correct this 0.4 that I think is history and give me a little more of a lucrative future? I'm going to use the 1.42. So back to the top. Okay. For purposes of comparison, I'm going to go out 10 years and say that my $1.5 million in value today, based on this modest appreciation rate, is going to be $1.6 million. Not a great 10-year appreciation. But let me change the 0.4 to 1.42 and then update my charts. Okay, the chart adjusts its scale, so it looks like it went down, but it didn't go down. Now my $1.5 million in equity up front 10 years later is $1.75 million. Okay, so what we want you doing is looking at the tea leaves, looking at macroeconomic trends on the market, and seeing that if you made some adjustments to things, what might you see happen in the future that would make this a great investment for you? Going back to the top, my yield of 9.48 is only a 10.9 now because I got a 1.42% increase every year, but that is still a big enough jump to put me into double digits. One last very quick thing that's great about the visualizer, I don't have any debt on this right now, but let me go to my down payment and say that I'm going to put a 35% down payment. Before I do, point of comparison, my net yield of 9.48 is of course identical to my cash on cash return because this calculator is set to assume it was an all cash purchase. So my NOI and my cash flow are the same, but not for long because I'm going to put in a 35% down payment, 65% LTV. And what I see now is that I've only outlaid $538,000 in cash to buy this now. I'm going to put a 6% loan on that. Now I still have my 9.48% net yield. That wouldn't change based on the debt, but now my cash on cash return is 13.72. And my overall rate of return is 15.14. Why? Because I'm borrowing at 6% and I'm yielding 9%. And that spread between yields and cost of capital is really, really favorable in a market like Cleveland. So my question is, okay, if I'm going to plunk down $500,000 and hope to get a 15% return on that when I account for my yield and my appreciation and my leverage, how does that play out? Oh, by the way, update charts. I can now see my cash flow change because I have debt, and I can now see my mortgage balance declining. And if I go out 10 years, really, really, really important fundamental of this asset class. Remember before I went from $1.5 million in invested capital to $1.75 million. I made $250,000. But now because I have this leveraged, I went in for $550,000 now, not $1.5 million. All right, the value was $1.5 million, but I only put down $550,000. 10 years later, I have equity of $908,000. I made $400,000 or $350,000 instead of $250,000. Now, how in the world did that happen when the property appreciated the same in both cases? Well, the answer is that my equity grows in two directions when I have debt. The top line goes up, the middle line goes down because I'm paying down principal. So over that 10-year period, instead of making $250,000 in equity, I made $350,000 in equity. Okay, and the one number we don't have for you yet, but we will soon, is the overall internal rate of return that balls together all of this stuff, bundles it into one number so you can compare an investment in Cleveland with any other kind of investment you might be thinking about. Let me go down to the market fundamentals because your question might be, do I want to invest in Cleveland? So now that I understand the numbers, Here's the mapping. You see some good clustering in and near the downtown. You can look at every individual property. These are not glamour shots. These are Google Street View images, all right? So this is totally transparent. Here's that price appreciation chart. Here's the population change. Now, here's where it gets a little touch and go. Do I want to invest in a place where almost everywhere in America the population is growing and Cleveland it is not, okay? What are the things that are causing that kind of a long-term decline? Will it turn around? We don't know, and I'm not going to project that. I just want to reveal what the data shows. Outbound migration is the larger bar in every one of these things. But look, the outbound in 2005, since 2005, the outbound and the inbound, the gap is closing a little bit. Okay, not as much movement, and we don't have the more recent numbers here. We have to get them, but you see a trend of the spread between outbound and inbound migration is tightening at the very same time that the price appreciation was beginning to, the lagging price depreciation in the market is beginning to catch back up again. Unemployment rate is around the national average and the state average, but here's the thing I think is kind of cool, the job diversity chart. When you hear about a city that manufacturing erosion is the cause of its woes, you want to go look and see, okay, well, how big of a deal is manufacturing now? It's come back somewhat, but is the city still dependent on manufacturing? Is our manufacturing boost right now short-lived because of federal government pressure on companies to come back to the Midwest on top of tax cuts to encourage those companies to do that? Let's take a look. Number one job category is education and health services. Number two job category, trade, transport, and utilities. Number three, professional and business services. That's a good one to be number three. Government, number four. That's a good one to be number four. Meaning the further down government is and the further up business is, the better health a city's economy is going to be. And here, whenever you see business and professional ahead of government, it's a good thing. Manufacturing is all the way down here at 10%. So if manufacturing did erode in the future, you're less likely to see a repeat of history in Cleveland because it has detached itself from dependence on manufacturing. Okay? All right, so the next thing that I would normally do is go do some research and talk to people on the ground. We're going to have a conversation in a few minutes with the owner of this portfolio who identified the houses, acquired them, renovated them, and now is selling them, and he's going to give us some local flavor and a little bit of personality. Thanks for watching. Okay, hey, I'm back, and I've got Brandon Reed, who is the owner, entrepreneur who assembled this portfolio. Hey, Brandon, how are you?
I'm well, thanks. How are you doing?
I heard you're actually not well. You have 100-something degree fever, and so this is a great example of what rugged entrepreneurs do, right? The show must go on.
Yeah, I saw a good quote the other day is an entrepreneur is someone that works 80 hours a week so they don't have to work 40 for someone else.
There you go. Well, we'll be gentle. I know that you're feeling crappy, and so, but I also know that you're passionate about this. That you're the owner and entrepreneur that put together this 24 property portfolio. You just watched the first part of the video that I did, where I did my analysis. Any highlights or any? First of all, did I get anything wrong? Did I get something right? Can you fill in some of the blanks on, first and foremost, the market of Cleveland? What's happening, and why do you think it's an interesting investment market?
No, I think most of it was pretty spot on. Cleveland is an interesting market. It's you know it went through some tough times, but it's really on a rebound, and I wouldn't be surprised if it comes back to I don't think it'll ever be. I'm originally from the Northwest,
Okay.
and I'm originally from Portland, Oregon, and in the '90s, everyone was, no one wanted to be in Portland. It was a rough city. It was, but now it's like, you know, a, a, a looked at as like a
Yeah, it's one of the best cities in the country, and everybody thinks it was always that way.
everyone wants to be there, right? And I don't think Cleveland will get to the Portland level because it has, it was such a big city at one time, and then it lost a lot of population, but it's growing. But the reason it's growing is because it's still a big city and it's affordable, right?
Right.
So a lot of millennial influx, a lot of companies are setting up there because housing's affordable, real estate's still affordable, and there's a ton of infrastructure in place already. So when we were looking into going into this market and building our own personal portfolio, which by the way we still own, close to 50 properties in our own portfolio, but now we're just starting to sell some off as well. we were looking for those key factors. Affordability, um, you know, a good economy, and a fun city to be in. A lot of people don't know. They think of Cleveland, they think the worst. I mean, it has some of the best museums. Rock and Roll Hall of Fame, some of the best food.
Yeah,
Um,
you're right. People don't always know that. Like I have to admit that I zigzag around the country here and do analysis of things. And as you know, I start with data and then I try to fill in the blanks with personal experience, as what we're doing right now. I forgot that Cleveland was on the lake until I saw it on the map. So,
well, there was just an article in LA Times that it was titled "Cleveland once called the mistake on the lake, now on the cusp of cool."
okay, nice.
'Cause it really is. And uh, but there's a lot of things going for it. I mean, you don't realize that the Cleveland Clinic is one of the major medical
Right.
facilities in the
Medical.
States. I
Let's
mean,
talk about that. That's great. So that they were, in a way, I mentioned in the other part of the video that what I had learned of the influx of new manufacturing, which has not become the biggest industry as it may have been decades past, but that the medical industry came in there. Was the Cleveland Clinic? I guess that was kind of a sun at the center of that solar system a bit, right? And a big magnet.
correct, correct. I mean, it's one of the top-notch medical facilities in the United States. And I would say within the world. I mean, you have Saudi princes flying in for their, examination, for their surgeries to get done there. I mean, the campus is enormous, uh, and the reason why they were able to build like that again is that at a certain, they started taking over that manufacturing, those things that were shutting down, and turning those into medical facilities and that kind of thing.
Awesome, awesome. So we'll encourage people to go out and do independent research to validate all the things you and I are saying. But I feel pretty good about every American city right now. Really, always have. And when there's pain, especially if there's short term pain, but there's long term gain inherent in it. In this case, it's been some kind of long term pain that Cleveland and other cities in the Midwest have gone through, but they've pulled themselves out. And one of the benefits of being able to be um, patient by nature. This is an asset class that requires patience by nature. And when you have the ability to be that way because your business strategy allows it, and you let yourself stand back and look at the big picture, when you get momentum back, like this was like a train that lost its momentum and had to get it back again. It's not easy. It takes a lot of power to get a locomotive and 50 cars behind it moving again. But when it gets moving again, it's damn hard to stop it. The reasons that it is moving are very real. It's not a flash in the pan. I mean, it'd be wonderful if Amazon chose Cleveland. I don't think you're on the short list anymore, but it'd be wonderful. But you don't even need the flash in the pan. You've got the grind of the comeback is what brought the city where it is right now, which only means um, that it fits for somebody that has a long term perspective. Tell me about, so people I'm sure are wondering if it's so great, why is he selling? So fill everybody in on what the reason why you're liquidating these assets now.
Just to bring in cash flow to the business, so I can go out and buy more houses,
Great.
and just keep doing what we're doing.
Do it again.
Uh,
Right. Perfect answer.
if I could keep every single house, I would. And originally when I started this, like I said, I still own. The cool thing about this portfolio is that you're buying a house and I own the house next to it.
Okay, that's cool.
So it just to liquidate, create some cash flow, and be able to expand and grow our team.
Because in your business, you guys buy things like, what do you look for when you buy a house, and then what do you turn it into? Which is this is the end result of your process right now. So fill people in on why you choose what you choose and what you do to it.
I mean, the asset itself, or geography, like
A little bit of both. I mean, you can look at the geography, a little bit of both.
Okay, so I'll start with the geography, and then that'll lead into the asset itself. So mostly where we're buying is in the west side of Cleveland.
Okay.
If you look at the map here, there's downtown Cleveland, and then there's the cool and like hipster, trendy neighborhoods is Ohio City and Tremont. And you
Okay.
got the Great Shoreway and Lakewood. Well, all these places in Old Brooklyn down here. So all this little C are all the greatest neighborhoods, basically, like really, really cool, growing neighborhoods in Cleveland. So then you have West Cleveland in the middle of it. And what's the natural progression? It's gonna, it's just gonna keep moving inwards, right? Those, from 10 years ago, Tremont wasn't a thing. 5 years ago, Ohio City wasn't as cool. Detroit Shoreway is now making its way down. So we're buying in that area, particularly because we're forecasting a little bit. We think those are going to be the keep growing and they're going to be a great asset to own in the future.
So this is
That
interesting. Let me stop you 1 second. So you're saying that on this side, so here's downtown up here, this
mhm.
western side, the markets that have already come alive and gentrified are on the outside, and what you're forecasting is this has already become hot. You're seeing it kind of close the gap where the rim where these properties are now kind of bookends with downtown to allow that gentrification to fill in the middle.
Yes,
Awesome.
that's what we're forecasting.
Cool.
So and as like I said, I'm from Portland, so there was a time where people wouldn't, where North Portland was a place they didn't want to be in, and just over time they had to go somewhere, right? You
Yeah.
couldn't afford in Ohio City, so maybe go two, 3 blocks over, and then it just keeps moving like that. And Cleveland's changing a lot. Like there's a lot of money. Like a lot of millennials are coming in. They want to be downtown. They want the cool bars. They want the cool stuff. Got a lot of medical professionals, but you still have a lot of factory workers, and you have some great renters. Solid, blue collar people. And it's funny when you talk to a Clevelander, they have so much pride in that city, and they're really working hard to make it as cool as it can be.
I'm trying to zoom in here. For some reason, my street view is not working. But I'm glad you brought that up. I've been there recently. I stayed right in the right in the downtown, a historic hotel that had gotten refurbed. I walked around, and the pride is one of those things that I think is one of the gems about all these Midwest cities. That people that are left, all right, there was an exodus. The people that are left hung in for a reason, right? You hear a similar sort of vibe. You pick up a similar vibe in Pittsburgh, in
Mhm.
Detroit. I mean, Detroit, 3/4 of the world was down on Detroit. Now it's starting to catch back on again because the beauty, of course, in the housing market is the yields that people who buy from you now are able to get are among the best in the country because the rough history that the city has sort of had to live through and then pull itself out of is priced in. So you've bought these things cheaper. You did renovations to them, which added value for you. So as an entrepreneur, you were able to make value for yourself by adding value to the properties. You turn
Yeah.
them into performing properties, which adds value to an investor. But even at the end of all that, like try buying a property from somebody in Atlanta or Dallas who did all that. The market's become expensive. The recovery has already happened in a big way in those places. And so the recovery is priced in. In your case, it's not really yet. The recovery isn't complete yet. And so the question investors have to ask themselves is if I do my research on this, or if I'm already in Cleveland and I want to double down, are the is it real? Okay, that we know the history is real. The question is the turnaround real? Have we crossed over some point of no return? I believe that the city has, and it's all because you're no longer overly exposed or dependent or vulnerable to manufacturing erosion. You replaced it with a bunch of
100%.
other things. But now it's also coming back anyway. So if it comes back, it's just another wind at your back. You already replaced it, but now it's back. And if it goes
Yeah.
away, it's not going to take you down because you replaced it. But there's really not much of a reason to think it would go away because manufacturing is not the easiest thing to take away. It's a factory, for example. So if you put the people put an investment in, they expect to be there for 25 years.
Yeah, but I mean, but there is still a ton of manufacturing going on. You
Yeah.
drive through Cleveland and you see the steel mills that they're still pumping and they're still working. So, I mean, you do have that good, solid blue collar renter still in place, and
Right.
especially in these areas. It's funny, you go down. I've had investors come in and tell me, they say, take me to the worst neighborhood there is, and I was like, there is no worst neighborhood. Everyone's lawns is clean. People are out there, mowing their lawn, cleaning up their property. They really take pride in what they in their houses there, and a lot of these houses are 100 years old. and you can tell that people have taken care of them for a long, long time.
Yeah, I think
Um,
that qualitative thing, the analysis is data and quantitative, and then cultural and qualitative, and the idea that the community there hung tough and stayed because they love it, and now it's their chance to benefit from that patience and that sort of grit to bring their city back. It's just good. Like I said, it's part of a lot of cities in the Midwest. It's a really really good resurgence, and it is the opposite of a flash in the pan. It's real. I feel very comfortable recommending Cleveland to people for that combination of reasons. So now, from the standpoint of your actual assets, just tell everybody a little bit about um, what you do to a house, why you pick one, where you pick it, in terms of when you see a house, because you're going to go and recapitalize your acquisition program with the money that you get from these sales. What do you buy? What do you do to it so that it becomes what an investor would be buying from you right here?
I mean, we're looking at it. It's basically a numbers matrix, right? I mean, we look for most of the assets in that area are going to be similar age house, similar size house, similar architecture, right? So, we're just looking at a numbers matrix. How much can we buy it for? What do we have to put into it in order to make it cash flow at this certain, ratio? Um, I say we go a little. We come from a retail side of the fix and flip world.
Okay.
Um, we've done that for the past 8 years. So I think it's funny. Some of the people that I work with are in that area. They're like, why do you guys do so much to these houses? And we really, the reason we do is because our name's on it, right? And we
Right.
want, and we have a philosophy, and the philosophy is, you know, if we have the best house on the block and we're priced at market rent, there's no reason for people to move down the street, right?
Right.
If someone's moving into a house that the the floors are, the carpet's dirty, the walls aren't painted properly, the bathrooms dated, they'll move out of that house
Right.
if they can move right next door to my house that's has brand new bathrooms, brand new flooring, nice countertops, brand new appliances. uh, you know, we try to finish out all our hardwood floors if we can, to save money on our churns. And sometimes that'll cost us $500 more than putting in carpet. But over the long run, that'll save an investor thousands and thousands of dollars. So yeah, as far I think we go a little above and beyond than what most people do, but that's just the way we operate and we like to do it.
Good.
I'd
Well,
rather
it's,
take
it's,
us.
it's penny wise, pound foolish when people go do the cheap renovation. Professional. So you turn out a portfolio of 24 properties. How long will it be before you have like another 24 that you want to bring out to the market like this?
At this current pace, we're doing probably 6 to 7 houses a month.
Wow. Okay. So somebody who comes along and says, "I like this story. I want to go into Cleveland, but I want to go deploy $10 million there." You could be a supplier for that person to get them to scale.
100%.
Awesome. And
We
I
have a great construction background in our crew. Uh, our project management is on point. I was just down at a real estate convention in Miami, and everyone was complaining about their construction side of everything, and I think ours is 100% on point. And it's maybe because we come from the retail side of things, and we've been doing it for so long. We have very qualified, overly qualified people, I would say, running these crews and running our construction side of the business.
That's great. That's great. I zoomed in on this photo here just because it illustrated your point that your house is the one in the middle here, very well kept. There's obviously pride in rentership going on here, but on either side you've got trimmed, landscaped shrubs and things like that. So this is the kind of block that, again, culturally and understanding people is important to be in the SFR business because every tenant's a customer, and if you it makes a lot of sense that a customer is going to take better care of a property when the people to the right and the left of them, their neighbors, the ones they make eye contact with every day, are also caring for theirs. They don't want to be the schlep who has their house in disrepair from a tenant's perspective. And then you, as the landlord who actually does most of those repairs, you feel the same way, which means it blends right in. Tenants do not like living in dilapidated houses that everybody wonders, well, why? Either they don't take good care of their house or they're a renter, and nothing wrong with being a renter, but some people don't need the world knowing their business. So It's good on a lot of levels, and it's kind of a quality thing. You know, people sometimes make the mistake in real estate investing to think it's all about foreclosures, it's all about junkers, it's all about flip, 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 quick money, etc. When in most other areas where they interact as a consumer, for example, they understand that there's a continuum. There's quality on one side, and there may be expediency on the other side. But you know, when you listen, when you walk into a restaurant and you know they clean that place meticulously, it's different than when you know they don't. And the overall experience is very similar. So, hey, thank you. It's good to meet you via the phone, and we're excited about people having a chance to experience through the this experience right here through the medium of video and audio online to get to know a little bit about the entrepreneur who assembled this investment. So, thanks for being here.
Yeah, thanks for having me.
Okay, hope you feel better, Brandon. Take care.
Thanks. Bye.